Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 21st, 2023. We'll begin by looking at the dashboards. This is the view from last week. Now, what I find about this interesting about this is this is as of last Friday, that for all four periods, the moving averages 20, 50, 100, and 200-day moving averages, which are the last four columns and to the right. All of the indexes that I measure, equity indexes, are all positive on all four moving averages. Pretty interesting. And they are all positive for the week and year to date, which is the center two columns. Isn't that interesting? Very positive. The last row is the 20-year government bond, and of course it's negative in a number of those periods. It's not moving up. But anyway, I thought that was interesting. A very positive statement for the market, at least for right now, as we look back for the past week and even year to date. The highest two by far are the NASDAQ 100, which is tech heavy, up 38%, and the S&P 500 up 14%. And then from there, developed markets up 11, and then it drops off. And at the very bottom, for the equity markets, the Dow is up 3.5%. And of course, the government bond is up 3%. Not very much, but not going down either. So, when you break apart the S&P 500 and look at the 11 industry sectors within the S&P, again, on the far right, you've got the 20, 50, 100, and 200-day moving averages. And going down from top to bottom, you have the names and the ETFs for each of the sectors in descending order. The highest performer at the top based on a year-to-date number, and the lowest performer at the bottom. So I've said this before, and I'll keep on saying it as long as it's true, and that is that those at the top in December for the last year were at the bottom. Not near the bottom, they were at the bottom. And those toward the bottom here were at the top. Do you remember a time in energy, for example, is at the bottom here? It is negative on a year-to-date basis, 7.56%. I remember in, I think, September or October last year, energy was up 64%. I remember seeing that number, and it varied throughout the year, but finished very positive. This year, it's gone right to the bottom. And technology, consumer discretionary were at the bottom, and now they are at the top. Matter of fact, there's so much at the top that they almost separate themselves from everything else. Technology up 39%, consumer discretionary up 28%, and then it drops all the way down to 7%, 7, 5, 3, 1, and then it goes negative. The last four sectors are negative year to date. So when you look at the S&P 500, it is a mixture of strength, especially in technology and consumer discretionary, and weakness, as described by energy and healthcare and consumer staples. Those were all strong last year, and now they are very weak. And then you can see, most of them are positive above their 20-period moving averages. The 18-month chart on the S&P 500 this is 18 months, and it's a weekly chart, so it shows the the movements are weekly movements, up or down, for the week. And at the end, particularly since about March, you can see that it has really gone positive. And in the last month or so, it has gone, I'd say month to month and a half, gone quite positive and going up into, where's it going? Maybe the stratosphere, I don't know. Going way up. Well, it's at least 2 standard deviations above the mean, and that is, that's going to come down. But right now, we have been fully invested in it, and we're delighted with the returns we've gotten because of that. So I am not complaining. I think it's a wonderful thing. But I also want to say we're tactical, so we are going to get out when our mathematical model says to get out. So, but until then, we've certainly enjoyed a nice run. And that prior to that, prior to March, you can see it was up and down a lot, and frankly down quite a bit. But when you split out the S&P 500 into growth and value, this is the 18-month chart, you can see from the beginning of the year, generally speaking, it has gone up. Well, growth, SPYG, the growth portion of the S&P 500, is the numerator. SPY-V is the denominator. So when growth is in favor, it goes up. When value is in favor, it goes down. You can see last year, that first, the first 12 months of that 18-month chart, you can see, generally speaking, it was in a downward direction. That favored value. Since the beginning of January, almost exactly, it has been moving up. But because growth was so much out of favor, it went down so far that even though it has gone up since that time, it has got a long way to go before it gets back to where it started. But on a relative strength basis, growth is still in favor at this point. On another relative strength chart, looking at the S&P 500 SPY relative to the Russell 2000 Small Cap Index, IWM, you can see that since March, it has been screaming upward, meaning that the large cap SPY is way in favor, and the Russell 2000 Small Cap is way out of favor, at least for this short period of time. And prior to that, you can see it basically went up and down a lot, but now we're heading in a new direction. We'll see how far it goes, but positive for large cap stocks at this point. The long-term government bond, as I said earlier, the long-term government bond is not performing well and is actually in this, let's see, I believe this is negative on a year-to-date basis, and this is the ETF TLT, and certainly it's gone sideways. I think that's what I tried to portray with the black arrow, is a sideways movement, really going nowhere. And this is interesting because last year you can see that not only did stocks or equities go down, but bonds, using this as a representation of government bonds went down a lot. And so they did not provide the protection for balanced or 60-40 portfolios that they had traditionally done. And now the stocks have gone up, but bonds have not participated in that. So now they are, both last year and this year, they are a drag on traditional portfolios. The US dollar, represented by the ETF UUP, this is a 24-month chart. You can see since October is in a downward trajectory. And prior to that, it was very strong. And you probably know the implications of a weak dollar. The gold has been in an upward trajectory since late October of last year. So that would put us about 6 months, generally speaking, an upward trajectory. Silver, same thing, except silver has been more volatile, which silver tends to do. It tends to have these big swings up and down, but when you look at a more of a macro view, the last 6 months, you can see that it is still, like gold, it is still in that upward trajectory. When I put the two on a relative strength chart, this takes us back to September, so this would get about, let's see, I'm sorry, I was saying 6 months, that was about 8 months. Now this is about 9 months, and over a 9-month period, generally speaking, silver has outperformed gold, but with some big swings. You can see these periods of way down and way up on a relative strength basis. But snapshot from September to now, about a 9-month period, you can see that has favored silver. Bitcoin has had a move up, had a nice move up during the first 3 or 4 months of the year, and then it has trailed off, and but it is still in an upward trajectory from the beginning of the year. Volatility index has come down. You can see where it was in October, around 32. That's a little, definitely a little elevated. And then has been in a series of moves on a downward trajectory, now all the way down to 13 from 32. I put my black mark at 24, indicating when it's above that, that's usually a period of higher volatility, higher risk, particularly if it is moving up through that black mark as opposed to coming down from it. Asbury Research does several metrics, and there are 6 indicators. They call it the Asbury 6, and this, I believe, is the 3rd week in a row that it has been positive, showing that all of their indicators are indicating a positive market conditions. Their cross-asset relative performance chart shows some things are stronger than others. The last 3 columns show the weekly, the monthly, and the quarterly view. So from those 3 views, looking at only the green boxes, you can see that stocks outperform bonds. From the previous chart, you can see they have way outperformed bonds. Large cap, from before, way outperformed small cap. The broad market, S&P 500, outperformed the narrow market, the blue chips of the Dow Industrials by quite a bit. Technology outperformed the broad market, the S&P, definitely. Growth outperformed value over those time periods. And in the bond area, corporate bonds outperformed government bonds. All of this is a reflection of what I showed you earlier. U.S. versus the world, I always find this so interesting. The number 1 country compared to the U.S. is Brazil, a developing country, emerging market, you could say 3rd world, and a wonderful country, but they are the number 1 performer relative to the U.S. for the last week, the last month, and the last quarter. All the others are maybe positive, maybe negative to the U.S., but not enough that you could establish a clear direction. I put a relative strength chart. I just compressed this to the last 3 months because that's what we're measuring, to just show you Brazil versus the U.S. Brazil is the ETF EWZ compared to SPY for the U.S. On a relative strength basis, since EWZ is the numerator, if it goes up, that favors Brazil. If it goes down, that favors the U.S. Gold and silver. So they have gone up. I showed you in those previous charts, have gone up quite a bit. Right now they are sort of at a top, or at least a short-term top, and we're slightly negative for this past week. Gold went down slightly, 0.3% to 1961 per ounce from the previous Friday, and silver is 24.23, down 0.5% from the previous Friday. The gold silver ratio is 81 to 1, gold numerator, silver denominator, and that kind of ratio favors the fact that it is a better time to buy silver than gold from a potential value standpoint. The monster box of silver, so 500, not coins, but ounces of generic silver, they call it bullion. A monster box of 500 of those is now $14,255 as of last Friday. That includes, you saw the spot price on silver, and when you add to the spot price, the markup is $4.28 per ounce for 500, and about a little bit more for lesser amounts. So for a round in 500, that's $28.51 per ounce when you buy it in the bulk of 500, and if you buy it in a tube of 20, that's $29.26. I get this data from my son Preston, who's in that business, and these are his prices. A credit card is what you use when something costs too much and you want to pay more for it. And the kid's kind of looking, are you kid? What did you just say? Okay. Thank you for watching. If you have questions or comments, leave them in the comment section below and I will try to answer them. Thank you for watching.